Greetings, everybody. This is Jeff Scott, and welcome to this week's top-down review. It is still the 25th, but although it says the 26th, which is I always date them for Sunday. I titled today is All That Glitters Gold, and then Can Big Tech Earnings Save the Bull? Interesting week. I would watch a healthcare news flash come over on one of my feeds saying another death, and then there would be another leg down in the market. Then the market would work its way up to the next death from this coronavirus. Talk about that as we go on. Very reminiscent of some of the days around Ebola and SARS, prior health scares, which come on fast, seem to be the end of what the market was doing, and then they're gone before you know it, leaving some broken stocks along the way. This is Jeff Scott. My email address is hgsidoc@gmail.com, and let's take a look. As always, this is for educational purposes only. I'm a doctor, not a broker. I have no licenses that would say that I should even tell you what stocks to buy, and I certainly don't trade on behalf of any other entity. I am independent. I have paid for the tools that I use and the tools that I demonstrate, and trading involves risk, and you and your loan are solely responsible for any investment decisions that you make. I always like to pay homage to those that got me to where I am. I've made money in the market. I've consistently made money in the market for years, but I didn't start out that way. I learned about canceling by reading a book. I learned how to trade with canceling from this guy here, Ian Woodward. Cancel was improved by Morales and Catcher. Ron Brown was Ian's partner at the end. Trades different style, but uses HGSI and is an extremely effective trader. My buddy George Lee from Western Canada, another great trader, although he trades in shorter time frames. Van Tharp, the king of money management. Cigar, who's got some great indicators and some ways of looking at the market. And then the person who I'll credit with teaching me how to take a list and the fundamental knowledge of how to trade, but actually making me into a trader. And that's John Person, educator, mentor, friend, software developer, and author. I can't say enough good things about him and how he has helped me hone my trading skills and helped me be consistently profitable. If you see my desktop, you'll see a lot of programs. You'll see a number of programs on today's review. The reality is I need TradeStation and Thinkorswim. I need a number of the indicator packages I use, including John Person's, and Cigars on TradeStation. I use HGSI for most of my chopping, dicing, and slicing the market during or after the market. The speed, the flexibility, and some of the indicators that it has that are unique make it a great platform. And then EdgeRater is another tool that I use. I supplement it with seasonality. We talked about NFLX, and I'll comment about that at some point before we're done today. And then a number of websites that I use. I am independent of this company, growstock.com, but I'm one of their many happy users. A free 30-day trial without a credit card under investing strategies. You'll see hundreds of videos from me and Ron Brown and others. It is not the most intuitive platform when you first double click on it, and I freely share with folks a video of my vocabulary and some videos of how I use the different tabs and how I've been able to turn it into the most powerful program that I have. Stock patterns are cyclical, and I might as well just replay what I've been saying off and on over the last several months. We just came back out of a big run over the last 3 to 4 months. It really felt like something happened on Friday. Volatility went up. Defensive things like bonds, metals went up, and the indexes fell. Now, then you look at the actual amount, it's like 1%. So it's possible that Friday will turn out to be just a hiccup on the way to higher highs. And frankly, I think it probably will be. But that's not to say that I don't think we might have a little bit of more pain. So I think at least for a very short period of time, I'm concerned that this market has some rollover potential. I don't think it has collapse potential. Maybe they're 3 or 4% down. which would just take Friday and multiply by 5 times to see what that would feel like. So because of that, I did raise cash, sold some premium, protected some of my bigger positions, and I'm poised to buy some bear positions contra ETFs if the market opens up or trades down on Monday. That said, I am still more long than maybe I should be right now. If you want to know what the definition of sea of red is, um, this is the TradeStation radar screen. I've just put the major sectors here. You have indexes, then you have forex, you have currency, futures, the grains, the metals, energies, um, gold, yellow, some soft goods, the sector ETFs. But when you get from my arrowhead down, you basically have the S&P sectors and some of their major constituents. And when you see a sea of red, it just means it was a globally bad day. Now, utilities had some green and maybe some real estate had some green, and those are defensive areas of the market. If I go into my Thinkorswim and we take a closer look at the various, and I like looking at the futures because sometimes they fall a lot, and then by the time the morning opens, you don't even know. Um, it's hard to be a mega bear when one looks at the S&P. The lowest day occurred back a year ago, and the highest day of the past year occurred on Friday. So it's difficult to look at that and say, this market is done, it's rolling over, it's over. It might be. It's just hard to say that on one day. Do I think this market can come down from here and maybe retest the 17-day moving average in green? Sure, it can. Is it likely to pull down further and test the 50-day? Well, why not? It does it all the time. But do I think this is a bigger, deeper pullback as we saw in December of 18 and haven't seen since? I don't see anything that tells me that. And I also could see this market just go right back up on Friday. Volume was heavy, not the heaviest, but heavy looking back over the last 10 or 20 days. So this is the S&P futures. And if I don't sound like a horrible bear, I don't think it's a horrible bear picture as of right now. If I look at the NASDAQ futures, you got a bit of a shooting star. So will this come down and potentially test? And that's still a big pullback. And we'll look at the cash index, the cash indices and HGSI. Could you do that? Sure you can. But again, the low of the last year was on the first day and the high of the last year was on the last day. So are we lucky enough to top tick this one and say it's done? Maybe, I don't think so. But it could be. And then we can look at the Russell here, the Dow futures. They peaked on Thursday, big down red bar on Friday, but looking at it, it's within the confines, at least the body's within the confines of Thursday's body. So I don't see something that says this is horrible, the market's going to implode. We had one painful day, down about 1%, and it took a lot of the overbought out of the market, as you'll see. The Russell hasn't looked as good as the others in quite some time, and has not taken out the prior highs here, which were from August of 2018. But it's also up near the high since the last big pullback, which was the December of 18 pullback. So the Russell weaker as it's not set any recent new highs, but trading near the top of its trading range. On the VIX, clearly it spiked on Friday. I have some VXX, which means the VIX will be coming down because usually by the time I buy the VXX to protect my portfolio, the market's done with it. But we will see. There's a thing called the volatility of the VIX. I think this is it here. All right. And it ran up as well, but You're kind of not at a horrible area. I mean, the VIX and the VVIX can get much higher. Maybe they will. Worth watching. But right now, you can say you had one bad day. And if we look at the dollar, it's stabilized a little bit. But if I pull this back into a weekly, this is a weekly, I'm sorry. The dollar is pretty much, it's pretty flat. Now, did I take a look? Were all these weekly? Let's see. All right, they all were weekly, but you know what? That's fine because I think the same thing is there. If I do switch these to the daily, just to keep me honest here, um, it really doesn't look a whole lot different. Our highs were on the last day. We've got new sell signals on the daily. We talked about the VIX spike and the dollar in the middle of its range. So, is the market over? Is it done? Is it time to go run into our foxholes? It might be. I just don't think so. So we looked at the markets. We're going to look again at the cash markets in a few minutes. Rates fall on health fears. Notice that both the 10-year and the 30-year, both the 10-year and the 30-year have come back some. Falling rates are good for REITs, MLPs, utilities, dividend payers, and home builders. Clearly, as I did my review, the dividend payers look good. The utilities looked very good. Not many REITs made it to my bullish list, but I'd expect them to start catching up if the rates continue low. Now, it's hard to see the yield curve turn down again the last 2 weeks, yet it's not down anywhere close to the inversion, and we'll see. But you know, with the rates coming down, the market's selling off for a whole day, and the spread narrowing a tad, you know, the talking heads will be talking about a recession. Now, yes, if you can look at both the small stocks and the large stocks, there's no question the AD lines came in a little bit this week, but they came in from all-time highs, and I certainly don't see any significant divergence between the AD lines and price that I might expect to precede a bigger pullback. Here you can see clear on the NYSE that it and the major bullish indices came in some this week, but still right off of all-time highs. No divergences there. And then if I look here, what is the one thing that went up? Well, rates are down, you know, bonds went up, and TLT was super strong this week. Now, the last couple of weeks, I've been concerned about breadth. Well, it's still strong, but clearly it's not overbought. It's come down significantly this week. And if I look at the 3-month new high, new low, it came down to the middle of the range. So where I was a little concerned, at least on this marker, that we were getting overbought and we'd have some sideways or pullback, that's now satisfied. Now, if you want to continue to be bearish, we're making higher highs, although we sold off at the end of the week on the S&P, yet the McClellan oscillator and summation index on both the daily and the weekly have significant divergence. That's been the hole in the thesis for the bulls, but you know, the market can go much higher from here. The buckets, these went from a very bullish tone last week to now 17% of the stocks in the S&P 1500 are below their Bollinger Bands. Not an extreme. An extreme is 30 or 35. But all it takes is 2 more days like Friday, and we'll be at a place where you would expect a reversal. Now, you can certainly reverse from here. That would be within expectations, but it can get a little bit more oversold. Very short-term indicator, but that is clearly gone from overbought to oversold. Now, sometimes at market tops, when you start to get risk of a major reversal, you'd expect to see a Hindenburg signal. There are not, the bulls are so high on both the NASDAQ and the NYSE, and although you're getting close to the necessary number on the new lows, they're still fairly low. No Hindenburg sign on either major index. If I do the all-common NYSE or look at an HGSI or stock charts, I do not see evidence of a Hindenburg omen. Market tone has, you know, these are kahunas in the major indexes. So when you start to see a bunch of them fire, you would expect the market to become less bullish. And what you did is you flipped to yellow across the board as far as the market strength, or mostly across the board. Sector strength, which had been strengthening, weakened, and now you've got clear weakness in discretionary as well as energy and finances. Now, why would discretionary fall? Sorry about that. Just had to, it's a quick call. Sector strength. Yeah, I got to change this video. Oh, let me. Sometimes I forget to change the headings. So sector strength weakens. All right. Canaries in the coal mine. Again, is this market over? These, and actually, for those who've been watching me, probably wondering, am I ever going to change out Priceline to booking on the list here? I finally did it today. So here's a list of the canaries. These have been major stocks, and the interesting thing is they're still major stocks. Had the same list for several years. This have been the leaders. The hypotheses are that if you look at the stocks that have been some of the best performing, create an artificial index, that this index may roll over before the major indexes are done. Is this done? Might be, but might not be. What did it do? It pulled into the 8-day exponential and moved up from there. So I would say the canaries had a reversed off their top, but they certainly have not broken down, and we'll see what they do this week. Now, if you were with me last week, I actually created a new leaders list. I don't do this often, but when I start to feel that we're approaching a major top, I use this as my early warning where I take the leaders at the current time. This was such a broad-based rally that I was able to take leaders across many different industry groups. I build an artificial list and I track it. And just like the canaries pull back at the top, it's still above the 8-day exponential, certainly not broken. So did this pullback that we saw on Friday that probably hurt your portfolio a bit, did it tell you that the market run is over? Absolutely not. It might be telling us that we've got to pause here. Maybe it's going to blow up on Monday if this coronavirus is bigger than we think, but the market still has not broken. Know your news and earnings. So there's some good stuff this week. New home sales, maybe they're benefiting by the low rates. We got Case-Shiller home prices, consumer confidence. FOMC announcement on Wednesday. Obviously, that's a big deal. Jobless claims weekly on Thursday, GDP on Thursday, and on Friday, you got some employment, core price, PMI, and sentiment. Now, what we've seen over the last many months is a miss in this is punished, at least short term. So these numbers matter. The issue on the FOMC and then Jerome's press conference, I think the market's going to want to hear staying the course and not calling out risk to the upside where they feel like they're going to need to raise rates. Probably more important than the news on the left are the earnings on the right. Now, heed my warning. It is a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. When I do my live meetings, there's actually a presentation I do called Earnings Roulette, because it's kind of like gambling, but there are ways I think you can improve your chances. And I do and try to make money on some things during earnings. Hopefully I'll remember to talk about some of that as I get near the end. But look at who's got earnings this week. Apple, Pfizer, McDonald's, MasterCard, Microsoft, Facebook, AT&T, Boeing, Verizon, Coke, Visa, Amazon, and then a bunch of the big oil companies. Do not think that this is going to have as much influence, perhaps, on the markets as a viral infection in China. Big week. So we stumbled on a China coronavirus fear. There's a flight to safety. There's an ease off overbought conditions, and discretionary stocks may be pressured. Would you be booking a trip to China today? Do you expect that this could lead to slowdown in travel elsewhere? I do. So airlines, hotel stocks, theme parks may be pressured, and hence the pressure in the discretionary sector. The broad market certainly weakened on Friday. Take a look at financials. I know Bank of America, JP Morgan had pretty significant down days. Big earnings might set the tone for market as more financials, big pharma, and big tech are setting up over the next 2 weeks. Short-term momentum will be dictated by new reports of cases in U.S. and deaths worldwide. This feels a lot like prior epidemic fears from Ebola and SARS. Expect brisk moves up and down, volume spikes and short-term gains in related stocks. Novavax, AlphaTech Pro, NNBC, VCNX, AGRX, AHPI are just some of the often very small companies that will have a flood of speculative volume in and major price spikes. And I bet you dollars to donuts, as my mother-in-law would say, that on some of these, maybe not Novavax because it's got a RSV virus and flu virus, but on some of these, they're going to spike up, and then 3 months from now, 6 months from now, we probably won't even know they exist. We've had a huge move over the last 3 months. Profit taking at minimum is warranted. I protected my major positions going into earnings, which means I put some collars on my Apple and my Amazon. I sold some positions, raised cash. I bought some gold and VXX just to protect in case something happened over the weekend, but I've not given up the bull thesis. One bad day does not mean the end of the run. So let's take a look from a top-down perspective onto the charts. Couple of different things I want to accomplish today that may not be the standard fare. One of the reasons why I'm doing this so early on Saturday this week is because I had less stocks to look at. The number of bullish setups was certainly diminished. Now, open up a couple of different things. One thing you can do in HGSI is called the group performance analysis. And what this allows me to do is it allows me to look at the performance of the various lists that I might be trading on. I'm not done this and recorded it, so hopefully I won't cause a problem. So I have the various lists, I have the percent change, gains and losers, etc. So I do this every week. So, on a bad week when my stocks were up 0.4%, more losers than winners, well, that's because Netflix helped me a lot this week. The stocks that I looked at going forward, about 0.5% increase, more winners than losers. The pullbacks waiting for a signal seem to be where the big move was. Then I like to compare how do I do versus the IBD 50 down 0.65, the S&P 500 down 1.03. One can see some of the sell signals. The trilogy sells were down over 4%, which is what you'd hope they'd be. So I look at this and I say, yeah, this was a pretty weak market when I see more red than black. But I also want to know how I compared versus the market as a whole. So I'm pretty happy with what I see there. If I look in TradeStation, I like looking at my high jump. Now, just as an alert, I'm going to change the formula a little bit on the high jump bar. So next week, you might notice a little adjustment in the numbers. Right now, I'm measuring between 0 and 100. And I've changed my TradeStation indicator to be between minus 100 and plus 100. So there's very small differences in the numbers. Conceptually, it's probably more accurate, and that will be in play next week. I've also put that into, let me show you what I did here. If you have TradeStation, I haven't decided if I'm going to give this away, as I typically give indicators that I have developed for me that are not, emphasizing the word not proprietary. I typically give those away at my meetings as a thank you gift for the people that come to my meetings. So what I just wanted to show you is that I created an indicator that will look across lists of stocks and others. Of course, I'm going to probably overwhelm my computer and kill it here. I don't trade that. data that will give me in the radar screen not only daily and weekly, but when there's enough data, a monthly high jump bar, just to give me a sense of where things are. So you'll notice that they'll be a little lower, considerably lower, using this format because we are looking at minus 100, not 0 as the bottom line. That said, let's take a look at what we have here. We have the S&P 500s have a new sell signal. That's a negative. Blue bar on the daily, the weakness in the short term, yet still green bar buy on the weekly and the monthlies. So short-term weakness. We continue near the top of our channel. That's concerning. We have the MACD divergence dots on the weekly and the daily. Again, we've talked about that before. These markets were stretched. We come down here, the weekly bond goes still green. That's good. And we've now come off of overbought areas where the high jump you see was 100, 96, 95, and now the high jump is down to 81.79. So clearly, we are much less overbought than we were. Short-term weakness, does that mean a couple of days? Perhaps. Could it turn into something bigger? Obviously, but I don't think it will. If I look at the Dow futures, very similar pattern, and we're at 79% in the old format. If I look at the NASDAQ futures, we are at 88% in the old format. And if I look at, let me change this to daily. Yeah, I have to change it to daily so you can see there's going to be a little bit tighter correlation there, 88, 86. And then if I look at the, and also a sell signal on the NASDAQ futures. And if I look at the Russell futures, they've been in a sell signal for a couple of days, and they're down to 70. So those overbought conditions, the stretching of the high jump, which really had me concerned, are now relieved. That's good to see. If we pull up HGSI, and let's open it up and assume it's updated. Designer. I'm going to look at market analyzer groups. I'm going to hit warehouse. And that's not what I want to see. So I'm going to drop down here to Major Markets Plus, warehouse. And I've added one thing to this list. I've added momentum. All right, so now there's going to be 26. That's not what I wanted to do. All right, let me check that for a second. MMTM. Back to here. And now I want to add momentum to this list. So MMTM. Perfect. All right, so now I've got 26 major markets that I like to look at, and I'm going to put what we call the top-down view on them. All these are in the program. You just may not know where to see them. The things that say person on it, I'll talk about later. They're not there today. I want to rank it by raw score. So the best things in the market right now were bonds, gold, utilities, volatility, dollar. Is that a surprise after what you felt on Friday? If I heavily weight the last one day, absolutely not. It was a tough day in the market. Let's open up. The weakest were biotech, small caps, mid caps. So the larger caps held up better than the small and mid caps. Let's open up the S&P 500. Now we're looking at cash markets. The index, we're not looking at futures, so there's some variation. Think of the days that the futures are down 400 points and turn positive before the open. You have totally different charts if you look at the cash, which is after the open, versus the futures before the open. I prefer looking at the complete data set, which is why I use the futures when it's available. I'm just setting this up. And let's pull this in index view. All right, so here's the one-day sell-off on the NASDAQ. You notice that arrow there, that's a John Person sell signal that came in. My weekly bongo is still green. You notice up here there's no Hindenburg omen. You notice we had a couple of red candle highs, high jump extended that came off the top. We have not thrown a phoenix, which would be where my arrowhead is, which would be a signal that the market had a follow-through date to the downside. I will be looking for one. I am still above the 17-day moving average. If this was a stock that I was interested in buying, I might say there's a channel that the stock is in, and I might be watching to see if it's going to break out of that channel. Right now, it's still in the channel, and it pulled up off the bottom. I think this channel is important, and if we were, I always like to think of three possible scenarios. I mean, the worst scenario for the bulls is this scenario, and that's certainly possible. I don't think it's likely, but it's possible, and you've got your 200-day moving average there, so maybe that's a target. That was your 50 or 200 will be turning up. God forbid we come down to there, but we could, still less than 10% away. So I think the low road is that we pull down hard. I think the high road is we go right back up to new highs. And I think the middle road is we just basically keep chugging along here until the market makes a decision either to go up to new highs or to break down. So I look at this, and it's hard for me to become super bearish looking at this pattern. I am aware I did buy some protection, but more related to the earnings perhaps than I think this market is done. That's the S&P. Dow Jones Industrials, does it look any different? I don't think so. I'm looking at this abandoned baby here in November where it looked like the market was rolling over, went right back up. These one-day pops, maybe 2 days, are about what we've been seeing. So more weakness to come? Sure. End of the bull run? I don't think so. Ask me on Monday night. NASDAQ, even less so of a pullback, hasn't even gotten close to its 17-day moving average. And then the Russell 2000 using the ETF of the IWM, the most choppy of the bunch, never took out its 2018 highs, but had a, when I say a beautiful run off the bottom, what does that mean? It means from this bar here to the high up here, it ran up 18% in 73 days. And from that day to the low on Friday, it dropped all of 4.4%. So, oops, maybe it didn't. I screwed that up. Hold on a second, let me run that again. 3.7% in 4 periods. Not the end of the market by any means. So this one is the weakest of the bunch, but it too has not broken down much below its 17. It's still above its 50-day moving average. I always like to look at the dollar here, which we know is up near the top, UUP. And you can see with the fears in the virus, the dollar rallied, although it's still below the 200-day moving average. It's about to have a death cross with the 50 crossing below the 200. If we look at the volatility, we already know that on the fuse it moved up some, and you could see it moved right up to where the chandelier stop was, and then it stopped. And you could see, or might not be able to see, it's kind of faint, but there's a person buy signal that came in on Friday on the VIX, a kahuna, a mobile breakout out of a squeeze. Would not surprise me if it went higher for a couple of days, hence why I bought some as a hedge going into the weekend. Now, gold and silver, if the market is volatile, you might expect something, and boy, it's almost a cup and handle breakout here on GLD. It was a breakout certainly from a higher base. It's been strong. If you go from when it broke above the 50-day moving average here, which was back less than a year ago. I've been less than super bullish on gold until that period of time. Multiple kahunas in a row were enough to get me excited. But if we just look from this break above the 50 to where we closed, gold has had almost a 20% run since June of last year. So gold has shown some strength. It looks like it's ready to run again, driven by the worldwide concerns related, I'm sure, to the coronavirus. Gold miners, interestingly, have been lagging gold, and this week they seem to improve some. One way to play the gold miners, and one that I have a big position in today, is Nugget. It's a 3X ETF, and we'll look at some gold seasonality before I get done. And if I look at silver, like gold, silver looks strong. So clearly the metals, my neighbors just made me a carrot cake. Boy, they know the way to my heart. All right. So clearly the metals look strong. Now, I added the momentum because I play a lot of momentum plays. And this will be another canary in the coal mine, I think, for me, that when this rolls over, and if it rolls over, it'll tell me that I need to be thinking something differently. It did have a sell signal come in on Friday, so that's something to watch. But again, rolling over from all-time highs worries me a little bit less than a market that's got a double top or something like that. And I can look at the 50, which is the Innovator ETF, which is an actively managed ETF of the IBD 50 stocks. Looks a lot like the Leaders Index and everything else. It was at its all-time highs, or recent highs, not all-time highs, kind of like the Russell. It hasn't taken out its 2018 high. It had a sell signal and a reversal on Friday. One day does not make a big change. Oil has been weak, looks weak. That could be the beginning of a hammer, and maybe you'll open up on Monday. Because of the coronavirus, and as I mentioned, the impact on travel, they predicted as much as a $3 hit to the price of oil, so that maybe can go lower. And then biotech, despite some of the biotechs being involved in potentially addressing the viral outbreak with a vaccine, I don't think I'd want to be long a biotech ETF today. Now, maybe it's time to get in because we've just had a big pullback and it's going to go back and retest. But I'm still worried about biotech, especially when I think of what's going to happen with Washington and drug price controls. But I've been early or late or wrong or whatever you want to call it on that for some time. So a pullback down here to the 45 range on the LABD and filling this past gap would not be a shocker to me. All right, so I hope I haven't depressed you. I think the market's going to potentially pause here for a little bit. I don't see a major collapse. And yes, because of news, the market could do whatever it wants and doesn't have to listen to me. The next thing I do in my analysis is after I've had a chance to review. Oh, wait a second. Hold on a second. That's weird. Hope I didn't just kill my HGSI. If I did, I'll have to do a quick restore and continue. Wouldn't be the first time I erased something I didn't want to erase. Let's see. Nope. All right. Let me go down to my market analysis group, number 7. The next thing I want to look at is industry groups, and you could see with the top-down view on, I have 175 industry groups. Now, HGSI and other programs basically maintain the industry groups for me, so I don't have to worry about the components of, say, an airline index. If I right-click on airline index, change industry group, I can see the stocks that are in the index. So go back. So I want to look at short-term momentum. I use my 2-day EMA up. And why am I getting nothing? Okay, let me just do this. Sometimes I get this little glitch. Of course, it never does this when I'm doing it for myself. So let me go back up here and just use these here. Industries, perfect. And let's see about the 2-day up. Let's see what works this time. All right. There were only 8 industry groups to the upside. There were 30 industry groups to the downside. So the short-term 2-day momentum is strongly to the downside, consistent with my prior theme. Semiconductors, internet media, banks, application software, consumer finance, semi-manufacturing, internet-based, autos, REITs, airlines, all the things that have been leading for the last 3 months. 3 months got hurt on Friday. Probably could be called profit taking. If I look at the 5-day up, to give me a little bit longer time frame, I have 16 groups to the upside on a more intermediate time frame. And if I look down at the 5-day EMA down, of course, I see 68. So this market has not, despite the fact that it really felt like something happened on Friday, this tells me that it's been weakening over the last several days. So if we go to the 2-day up, here's the top 8 industry groups. Highlight precious metals, right click, change to industry group. Let's take a look. And I can tell you that the first 2, if not the first 3, made it to my buy group this week. So this is called top-down analysis. We've made our decision about the market, which is cautious, not necessarily over bearish and rolloverish, but caution. So what I see here, gold ran up, went sideways, sort of a saucer handle. I mean, is this a cup and handle breakout? I mean, I could squint and maybe want to believe it, but regardless, it pulled down to the 50 and the handle. Looks like it's trying to break out here. Everything is green here. On the weekly, it looks strong with a weekly kahuna and a bongo. I think this looks very strong. It makes money. Greater than its growth rate, or than its multiple. I like American Barrick here. Well, that just shows my age. I like Barrick Gold here, and I think that looks interesting. All right. Newmont Mining is another chart that looks excellent. Broke out, ran up, sideways move here, sort of a wedge forming and breaking out. Had a mobile breakout, definitely under accumulation. I don't count this as a high close doji, even though it's green there, because it's in an uptrend. This has been a leader in gold. It too has earnings. This one looks strong as well. Newmont Mining Corporation. On the silver side, this is PAAS. Pull back to the 50 and looks like it wants to go higher a couple kahunas. I like this one as well. Hard not to like these here, sitting on the base. Now, I've tried AU before and it just went sideways. So I like the momentum perhaps better on the Newmont and the American Barracks, but this had a new buy signal come in a kahuna as well. So there are some things if you want to feel like the need for speed and to be buying. The utilities, chasing yield, chasing defense. Boy, this thing's been a beautiful uptrend, tight, everything. I should have put this in my leaders list. NextEra Energy pays a 1.9% dividend. It's now getting a little bit extended for my taste. American Electric Power, not quite the ascent of NextEra, breaking out with a big leg up here on Friday, again, or the last week, extended for my taste. Southern Corporation, again, broke out. So clearly utilities, and these are the integrated, look interesting here. You could go after just XLU, but it too has broken out and it pays a 2.8% dividend. Look at the demand. And I think what's happening here is people are buying the ETF and that's forcing the ETF to buy more and more of the underlyings. Utility networks, Another one on the top, Pacific Gas and Electric, PCG, which I guess is different than PG&E. Certainly not overbought. It's been a significant downtrend. About to break above the 200-day moving average, pays no dividend, but it's under demand. Evergy has broken out and run up 2.7%. Consolidated Edison, 3.2%. Eversource, 2.3%. My problem with the vast majority of these is we're probably a little bit late. But when you start to see precious metals and utilities, electric power equipment on top, it should tell you a little bit about where this market is. This market is, that's tell you there's risk. It's simple as that. GE has had a huge move off the bottom. Looks like it's stalling. Earnings are this week. Generac, the generator company, everybody in my block has one. Everybody in my neighborhood has one. God forbid you have a hurricane and you don't have one. You just hope your neighbor does it, maybe even better. Big uptrend, gapped up here on Friday, mobile breakout from a squeeze, pocket pivot, Kahuna. HCD doesn't count because it's in such an uptrend. Again, do I want to buy a stock that's been this extended? No, but this is what people are buying right now. Also in the list is ABB. Doesn't look nearly as interesting. Rail freight, which is kind of interesting with energy being down, freight is actually doing okay. Union Pacific 2% dividend. I don't know if this is about dividends and safety. These don't look near as exciting as the gold plays do. Looking through those. All right, renewable energy equipment, Enphase Energy. I've been in and out of this one. Maybe I should just be in it and pinch my nose on the bad days. We've talked about this one before. It's in a nice bullish run, great earnings per share growth, lots of demand, does not pay a dividend. Solar Edge is another one that's done very well. Also in a nice run, no dividend, under accumulation. First Solar kind of looks a little bit different, doesn't it? Much less attractive. Telecom carriers, a place to hide your volatility, maybe get some yield. Here's Cincinnati Bell. Very strong relative strength. The Kahuna on Friday, mobile breakout and a Bible gap up. Not my kind of stock. I don't know if this one's under a potential takeover with the sideways move here. Go to more info from Webb, and this is one of the cool things of HGSI. You just pick which news service you like, and it opens up your stock. All right, so it's shareholder loss buyout. Okay. All right. You don't need to talk much more about this one. It's a buyout. I don't know anything about this company, and I don't know how secure the dividend is. It has revenue, doesn't really have much in earnings. Consolidated Communications Holdings. You can see the group strength. Mobile breakout from a squeeze. Kahuna took out the 200-day moving average. It's a cheap stock, pays a 7.7% dividend. It's on my buy watch list with the caveats. It's a cheap stock. Let's see if anything else looked interesting. Now, I'm a big fan at the right time. Here's Ring Central, which has been a big mover. It's extended, had some red candle highs. I'd probably be careful with it right now. AT&T must have been down on Friday because it didn't make the list, or maybe I like buying AT&T after it pulls back. Right now we're sideways. It pays a 5.3% dividend. I mean, these are things that I like to hide in when markets are having a rough time. Payment data processors. I thought Eventbrite put on programs. I don't know that. You got a stock that was obviously beaten down, IPO, nice gradual move. In fact, you could get kind of excited by this looking at it. I could be looking at something where I've got some channels here. and channelingstocks.com, we're up near the top of the channel, which I probably wouldn't want to buy, but a mobile breakout from a squeeze, a couple pocket pivots and a kahuna. So maybe I should be paying attention to this one. That's Eventbrite. PayPal's been a good mover over the years. It's kind of getting back to double top zone. There's a break out of here. Not a candlestick that excites me, which means it opened here, traded higher, then gave up much of its gains by the end of the day. But considering the day we have, maybe that was a good thing. Folks, that's it from the top groups. As I said, it wasn't a long review for me for this weekend, and so I had a chance to do a couple extra things that we're going to look at right now. So before I get there, I like to show you my buy watch list and see if there's anything on this list that I might want to recommend you go look at. You'll notice it's kind of small this week. If we look at industry groups, you can see there's a lot of precious metal and mining stocks, both of those renewable energy stocks, that telecommunication stock, a couple of insurers. Here's an IPO that I just love. It's an insurer, but I love its pattern. Move up, sideways move. If it clears this chandelier, I want to be long. So this is on my buy watch list. This is a high close doji, which is a high probability signal. Probably the ones that were surprising here. We'll go through them real quick. There's only 22. TLT, it's off its highs. Huge demand, pays a small dividend. If this market goes south, if we hear talk about recession, you're going to see bonds do well. If I want to believe this market is rolling over, this is the SPXS. It is a 3X bear fund. If I think the S&P is going down, this is a way to play this because it will go up. Some of you have ETFs, IRAs that do not let you play to the downside, but you can buy this long and get the benefit of a falling market. Now, this is a falling knife. It had a green candle on Friday on both the weekly and the daily. It had a buy signal. It had big volume come in. Clearly, as people are getting concerned about the market, this is one way to play it. Typically, I do this for a quick in and out when I think there's a reversal, and I play it with options so I get more leverage on top of the leverage. Duff and Phelps Utilities. I found a fund. Must be a closed-end fund because of the way it trades. Let's see. Closed-end diversified investment management company. So Duff and Phelps Utilities income pays a 6% dividend. You can see it's been a sideways mover. It doesn't move much. It's a vehicle for dividends. Doesn't trade a lot, 350,000, 340,000 shares a day. But if you want a place to hide with a good dividend yield that actually was up on Friday or flat on Friday, no, it was up a penny. DNP. Gold miners, this is Nugget, which we looked at before. It's a little riskier play on gold. This is Silver Trust. This is an ETF for silver. Again, mobile breakout from a squeeze. Everything's green up there. Pocket pivot and a kahuna, the kind of things that I like to look at on stocks when I buy them. Small cap, just like the SDS. This is a 3X bear ETF on small caps. If the Russell falls, this goes up. Once again, just for newbies, just because it's on my list, it doesn't mean I'm going to buy them. What it means is I take these lists and I have a larger universe that I play with, and I will put them at the bottom of this list, and then I will look for intraday signals to give me a clue as to what I'm going to do. Southwest Airlines. Now, I said a lot of negative things about travel industry. Well, this is one airline where it doesn't go to Asia or Europe right now, if I'm correct. They do have a 737 MAX issue. Earnings are out. You can see they traded down and then closed up on the week. Couple kahunas in a row and pocket pivots, mobile breakout from a squeeze and a high close doji. It's too loose for my taste, but all those bullish signals mean something to me. Air products and chemicals, this has been a nice stock. Looks like it's breaking out again. 1.9% dividend. Sienna Corp, why did I pick this? I picked this because on a bad day, it had a mobile breakout from a squeeze, a pocket pivot, a kahuna, and its earnings must be out because their next earnings play is not till March 3rd. Here's NextEra Energy, that big leader I showed you earlier. Here's that Palomar, that IPO insurer. Here's the other insurer, uptrend pullback to support in a breakout. Pays a 2.3% dividend. Here's that Eventbrite, which I mentioned earlier. Here's one of the mines, AEM. It hasn't broken out yet. It's got great earnings per share growth, pays a small dividend. One of the things I like about this one is it's not just gold. It's got silver, nickel, and others. Here's AU. We already looked at this. Here's Barrick. We already looked at this. Here's Newmont. We already looked at that. Nova Gold is a cheap gold play. Cup handle trying to break out. Pan American Silver is one of the ways I like to play silver. I looked at Enphase and Solar Edge already. Here's that communications company with a big dividend. So probably the least exciting from a typical bullish perspective list that I've looked at. So let's now talk about earnings and sort of the earnings bonanza of this week. So a couple of different things. I have a number of friends that I've talked about gold. And do I want to be long gold here? I think there's many reasons to be long gold here. And one of the reasons is, are you going to work or not work? Let me try. And one of the reasons to be long gold here is because of the economy, what's going on in the marketplace, and with the healthcare scare, etc. The program I'm trying to use is seasonalitytrader.com. I am extremely unhappy with the various seasonality programs in the market. And this one sort of has left me down and others down in that I'm a lifetime owner. They had a fight of the developer and the owner, and the program does not seem to be supported, and he's no longer returning my emails. So if you're a user, you might be emailing him too, asking, are you still supporting your program? So from a seasonality perspective, and let's look at the underlying metal, gold. Okay, so what you're seeing here are candlesticks, and you're going back from August through today, so you've got about 5 months. The yellow line represents a predictive value based upon 10 years of seasonality. The green line represents 5 years of predictive value on seasonality. Now, what I like to do is I like to say, well, sort of in a channel here. So let's just look at this channel. You see, I'm in a channel going up, and I want to change one other thing here. Oh, let me see. There we go. So we're in a channel. We're in the middle of the channel. Gold is definitely going higher, and it's been up 6 out of 10 years. So that's not that exciting. It's exciting because I'm in a channel that's going up. It's not a major season play. Gold is strong seasonality here. I'm looking for things that are 9-1, 10-0, 8-0 as potential seasonal plays. So here's some of the ones I wanted to look at today. Some of the ones that will be reporting this week. Let's start with Apple. Type in Apple into symbol. And let me do this. Hold on 1 second here. Window configuration here. Okay. So Apple has been in a very tight range. What a move Apple's had. It's at the top of its range. Now let's just take a little breakdown here. So Apple's in a super tight range, and that range has got a growth right now of 327% annual growth, which is not sustainable. We're going into a strong seasonality time of year. That's why this green bar is here. And we're up from February 3rd to March 16th. We're up 10 out of 10 years with an average return of 9.9%. So if you get a pullback in Apple with this market that we're in today, and Apple starts to go up again, Apple's got huge seasonality coming in, and it's not coming in on the day of earnings. Let me make sure I move the earnings around before I commit to that. Well, it does come in on earnings. So it's got a huge move up consistent with earnings. Now, Apple just had suppliers increase production of semiconductors. There's talk about Apple coming out with a lower cost phone. Apple's a beneficiary of the quieting down of the Chinese. Apple potentially pops on earnings. So if this market doesn't roll over, Apple earnings are on the 29th. I'm going to be closely watching Apple and see if I want to do an earnings play. Another one with earnings this week is MasterCard. You might think that MasterCard and Visa would be strong this time of year, and they might be strong because they had good sales over the holiday. And again, channeling here, so let's take a look at this. What you have is a stock in a nice uptrend at the top of its channel. When it's at the top of the channel, it typically is going to go back in. Its earnings are on January 31st, which is when I turned 62, so that's a good earnings date for me. And it's been up 10 out of 10 years in January with an expected return of 7 points between January 29th and March 10th with an expected return of 7.6% on a stock that's at around $300. That's a $20 move. I'd love to see it pull back a couple days, and the seasonality suggests it might, but that looks interesting. Now, I also use a package in Trades and Thinkorswim. I'm going to review Netflix before we get done today, talk about how I played it, and it's probably the only reason why I made money this past week. So what I see here is this is just a chart of MasterCard. Obviously, it's had a big run. The white is predicted seasonality based on historical, and the blue is kind of based on taking that seasonality and adding it to where it is today. So it's projected to go higher. It's another way of looking at the same thing. So MasterCard looks strong. If MasterCard looks strong, I'm in Visa today. Do I want to add to my Visa position? Let's change this to quarterly earnings. And cancel. Let's pick the earnings statement. I'm just going to go see here if there's a way on the configuration. All right, so like MasterCard, we're in a very tight move here. We're at the top of the channel, so you'd expect it to come back in. It's up 9 out of 10 years with a return of 7.4% between January 29th and March 20th. Now, technicals trump markets. This thing is extended. It has a couple days to come in with the markets, but seasonality would say that this thing is going higher. Microsoft has earnings. Finally found something that doesn't look as good. So Microsoft, it's within its trend at the top, and Microsoft has a risk of coming down here. So let's look back here, and Microsoft actually, it suggests a bearish trade, but I see it's only positive 4 out of 10 years for a 2.3% return when it's right, and a 2.9% return when it's wrong. That's not good seasonality. That's not good predictability. I'm not going to be interested in Microsoft as a seasonal play. Why does this matter? Because all of these plays, if you haven't figured out, are right around the time of earnings. And these are all about earnings. And all right. I think one of the problems with the program is I think I max out its ability. Maybe I've got too many windows. Let me close it down. So if I see strong seasonality every time they have earnings in a specific month, then I feel pretty good that that seasonality might be a positive thing to help me give me an edge to help me take a trade. Here is Facebook. It has not been traded for that long, so that's a negative on seasonality. We set this to earnings. The more years I have, the more conviction I might get. In a very, look at this, despite all the craziness with Facebook in a very tight channel, its upside growth is annualized at 104% in the middle of the channel. From January 17th until March 6th, it's up 6 out of 7 years, 12%. So Facebook seasonality looks interesting. What did I just do there? I hit something, and I wish I could tell you. Oh, who knows what I did? It's gone. All right. Oh, I know what I did. You can look at each individual year and get a sense of what it did and get an idea of how consistent it was. I just look down here when I see 6 out of 7 years, I get excited. All right, the next one I want to look at is Amazon. So those who know me know this is by far my biggest position. I do lots of option plays around it. So looking at this, it's a much slower growth. Its upward growth is 143%. Well, that's not too bad. You could see that the most recent 2-3 months, it's been in an upward channel. It's the bottom part of the channel. It's up 7 out of 10 years starting January 21st with a return of 5.5%. I don't consider that a big edge. I don't think I'm going to let that number influence what I do with Amazon. What about energy like CVX? Chevron has earnings on Friday. What does this tell you to expect? Tight channel going down, coefficient of growth of 252% to the downside. In the midst of a negative earnings period, let me go ahead and change this to quarterly earnings and drop our date on it of February 1st. Right in the middle, 5 and 5 though, so it's kind of not a big difference, so I would pass on it. We looked at gold. Let's look at silver. Just very curiosity sometimes kills a cat, but let's see if there's any seasonality around silver. Nah, it's not a really clear-cut picture, so that won't use that. How about oil? There's seasonality around oil. I don't know how many years USO has been traded. And there is seasonality. Unfortunately, it's not been traded long. It looks like there's strength in oil starting in February, 7 out of 10 years, average return about 8.9%. Right now, I'm not saying to do anything with oil. So I use this program among others. Now, just a couple of different things I'll show you. Let's look at Magenta. Magenta was another of the original seasonality programs that I owned. This one has now changed owners. I hope that the prior proprietor, Derek, sometimes I wanted to ring him up. but all in all, he wasn't a bad guy, and I heard he had some illness, so I hope he's doing well. So let's just punch in. Let's look at MasterCard here. Different programs, um, browser-based, and you can see the big one. What this one does that's cool is I'm going to go into the variable scanner, and I'm going to hit that. And what's it telling me is that it doesn't like the next few days on MasterCard. Over the next 10 days, it's been down 8 days in a row, but then it had a 10 and 0 up 6.42% starting on February 11th. Its earnings come out January 29th. The numbers should match up, but there's different algorithms that they use. Let's quick look at Visa. And it doesn't see, if it doesn't give me a green box, I'm not too excited. Now, Apple, we said looked good seasonality because the stock has had such a big run. And let's hit the, and you can see starting on this date here, which is February 11th, was their sweet spot up 10 out of 10 years for an average gain of 10.76. So they're suggesting to wait to get in. So I use this just to get an edge of where there might be, I'd rather have wind at my back than in my face. Now, in EdgeRater, they have a seasonality program, and it looked like this stock looked interesting, Fabrinet. Don't know when its earnings are, so its earnings are not to February 3rd. And it's in a nice tight little channel here. And let's see what it says about, right, it gives you a nice number there. But I'm going to leave my arrowhead here and look over to where it says on the left, where it gives you a calendar year and a percent return. And it shows that if I bought it on Monday, it's been up 9 out of 9 years and an average of 13.67%. And that is prior to earnings, which are February 3rd. So those are different programs on the market that I use to support seasonality. At the end of the day, these are good for giving me sort of advance and percentages and performances. But where I spend most of my time, I think I just maxed out my resources, so I get out of this. Perfect. Is I will come down here. Again, let's just look at Fabrinet. God, this has been a beautiful stock, and it didn't have enough seasonality to set up this program. So I've showed you a lot of things today. Let's review Netflix, and let's talk about what I did. Wasn't my best year. I didn't make hundreds of thousands of dollars on it. And the reason why I didn't was I didn't have the same conviction. And, you know, perhaps that was a mistake. I went into with 5 or 6 different positions. I had a deep in the money 325 to 327.50 call spread. I bought it for $1. I sold it for 2.5. I had 150 contracts. So that was to pay for my losses if I screwed up the rest of the way. I had a 320, 370 call, which expired on the weekend, which was profitable at about $33 on because the short call expired worthless. The problem is that wasn't a cheap call, the 320. So I probably made about 50% of the price of that on top of it. So I think I paid like $12, $13 for that call spread. I did a bull put spread where I sold 325s and bought 320s to generate some free money if it went up. That worked out well. And then I bought a couple of flyers above 360 long calls that were cheap, which expired worthless. Net, I made money on it. That's why I had a positive week. It was a tough one because if we want to just look at, when I look at 5 days, 15 minutes. After earnings came out here, the stock ran up and then it came right back down, got as low as 323. So those 325, 327.50 call spread that I had a lot became negative. But as you can see, the stock ended up running up, sold off a little bit at the end of the day on Friday, but Netflix did well. I have Apple. Of the ones I went through, I currently own Apple, Visa, Microsoft, Facebook, Amazon. I have a bunch of gold. So I'm going to have to be thinking a lot this weekend about how I'm going to want to handle this. I also wanted to show you Apple here. You go, well, how's that Apple? Apple's at its highs. Apple peaked at this bar here was 11 a.m. on Friday, and Apple sold off. This was 323.33. Apple closed at 317. It was down, or 318.31, down only 92 cents on the day. Let me flip back to a daily chart. But I think it's important to realize that Apple sold off at the end of the day, hit the all-time high, and then sold off. So at this point, I'm going to say goodbye, but I think this week's going to be interesting. What I want you to take home as a theme, I think the market could have a few more days of weakness and get a little bit more short-term oversold before it rebounds. It's going to be heavily predicated by what we see happening with the coronavirus. As a physician, I don't know how the world heartbeat goes up and down with a single death. Every person's got value, and a person dying is a big deal. But if you look at the number of people that are killed by drunk drivers tonight, will dwarf the number of worldwide people killed by coronavirus. But that's what markets are about. And if you believe that this is a pattern that you want to put all your money in Alpha Tech Pro, God bless you. It's not a pattern that I want to do. So be careful with these stocks. And NVX, I think is another one. No. There are a number of symbols out there that, I mean, this one is actually a real company. They're all real companies. And it too, I'd be careful with, Novavax. So on that note, I showed you a bunch of things today. I talked a lot about the market. Long term, we're higher. I do think we have some weakness to come. I showed you how I use seasonality with one of the programs. I showed you some setups, and then I showed you a very defensive list of stocks. I hope you have a great week. Sorry for some of the distractions that I do this. When I do these during the day, my neighbors come over and bring me a carrot cake for my birthday. It's hard for me not to get excited and make noise with my wife. But you all have a great week. Bye now.